In this episode, we're going to make you negotiation ready because we are going to talk about incentive lingo. What do you need to know when you are negotiating to impress the person you're talking to?
Hopefully get more.
Hopefully get more.
Yeah.
So we start with the first one, STIP. What is it?
Short-term investment program. Typically, that's under 12 months what they're referring to. And typically, we're talking about a cash bonus.
A cash bonus. Then we have LTIP.
Long-term incentive program. Typically, they will mean an incentive program that lasts for longer than 12 months, often 3 to 5 years.
Okay. Vesting.
Vesting, that will mean that even if you get equity, shares, or something else up front, you need to earn them over time. So you need to stick around, work, and contribute. You need to vest the shares.
Okay.
Or other equity.
Cliff vesting.
Cliff vesting means that you will vest nothing for a period and then you start vesting. So if you have a 3-year period, you can have a 3-year vesting period cliff, meaning that you invest nothing for those 3 years and then you invest everything.
And that takes us to linear vesting.
Linear vesting means that you vest proportionate. And that means that if you have 3-year vesting, for instance, you can vest linearly every quarter. So if you leave after 2 years, you will have vested 2/3. And you can combine cliff and linear vesting. You can say you have a cliff for the first year, and then you will have vested 1/3. And then after that, you will vest linearly every quarter or every month up until the 3-year period is up.
Okay. And bad leaver.
Bad leaver, that means you leave the company for a bad reason. That can be a material breach of your employment contract, material breach of the shareholders agreement. It can be because you leave and pick up and go to a competitor. You leave for a bad reason.
But if you're a good leaver?
I'm a good leaver when I'm not a bad leaver. I leave for a good reason. Imagine that I get sick or I die. That's a good reason. And that will typically mean that you have a softer consequences in relation to your incentive program and what you get to keep.
Clawback.
Clawback, that's nasty. That means that even if I have earned something, you can claw back, take it back in certain specific instances. And what's good to know is that many jurisdictions will have employment protection that might not allow a clawback in any way, shape, or form. So even if somebody tries to impose it towards you, make sure they have a right to.
Okay. KPI.
KPI is key performance indicative. And that is when you have an incentive program, you're going to be measured by something. In a bonus, perhaps I'm in sales, I need to sell at least for 2 million each year. Then that's my KPI, I should reach 2 million. Or for a long-term incentive program, the company stock, if it's publicly traded, it might need to grow 20% annually in order for me to be entitled to full-out remuneration of the incentive program.
Lockup.
Lockup, typically, if you have an incentive program, stock options or something in a startup, and that will go to an IPO, a public offering, get traded on the stock market, then it will be a requirement that us holding shares or equity in the company will stick around. We'll lock ourselves in for 12 or 24 months so we don't inflate the value of the company, sell it on the stock market, and just take our monies and go.
And then we have warrants.
Warrants. That is a security that entitles us to get shares in the future at a predetermined price.
Synthetic options.
Synthetic options, those mimic real options. So you have the same terms, but instead, when that exercise period comes, where you have a right to exercise, get shares, you calculate, so you get cash, because they're synthetic. So you calculate as if you would have had warrants.
And then we have exercise price.
And that is that predetermined price. What price? So that you will compare to the market price of the share. Is it higher or lower than the market price of the share? the right you have to exercise and buy shares for.
Strike price.
Strike price is the same as exercise price. Good to know.
Good to know. Exercise period.
Exercise period. That is the period where you have a right to strike or exercise the warrants or the options, where you have a right to decide if you want to use them to buy the shares.
Strike period.
The same as exercise period.
Okay. Out of the money.
Out of the money. That means that the option price, the strike price, that is higher than the market value of the shares. Because then it's not financially rational for you to use the warrant. Typically, you will want to buy the shares on the open market if you can instead.
In the money.
That's better. That is when the price you get to buy the shares for, the strike price, is lower than the market price. So it will be financially rational for you to use the warrants or the options.
Wow. Thank you.
Thank you. Hopefully it helps you so you know what people are talking about.
Yeah, so now you can negotiate like a master if you get the opportunity. And we're gonna keep on doing this. You get free knowledge about business law, and we have Kat here with us every time. We're so happy to share this with you, and now master your business like a real master. Bye.
Bye.